To catch a falling knife, you need to watch out for 3 criteria. A big bearish momentum down, a flush of a key level, and finally the confirmation candle. In this video, I will walk you through the process of catching a falling knife so that you will be able to get in at the lows. Now, catching a falling knife isn't one of the easiest things to master. This is definitely not a beginner-friendly trading strategy that a struggling trader should use. It's difficult, and that's also why it's the most profitable. Just imagine if you were able to get in at the low right here, get in with a tight stop loss at the market bottom. These are the kind of trades that you can obtain crazy reward to risk, like 1:10 or even 1:20, meaning to say that for every dollar you risk, you could potentially make $10 or even $20. Most traders approach this wrongly. They think that, hey, let's just buy at a support and hope that support holds. Or worse still, they enter in using a buy limit order without watching the price action at the level. This is one of the fastest way to lose money and why most people burn their hands when they try to catch a falling knife. The trick is to watch out for the 3 criteria: the momentum down, the flush, and lastly, the confirmation candle. So before I jump straight into explaining each of the 3 criteria, please do me a small favor and hit that thumbs up button. If you are new to the channel, do hit that subscribe button as well, because I create new videos every single week. I know that this videos is going to shorten your learning curve in trading. My team also runs a free Telegram channel and we send out signals almost every single day. So if you haven't joined us, do click on the link in the description down below to join us. It's totally free and you get a ton of value there as well. Anyway, moving back to the first criteria. Now this criteria is obvious, but nonetheless, to be thorough, I have to include it. There must be a strong bearish momentum. If you want to catch a falling knife, then price must obviously be selling down strongly. In fact, the stronger, the better. You don't get bottom prices without a strong sell down. Price must inevitably sell down so that you can get in at the bottom and catch the reversal of the bearish movement. This first criteria is simple and obvious, so I don't wish to spend too much time. Now moving on to the second criteria. You have to watch for what I call a flush of a key level. What this means is that price must close below an important level. In a sense, it's like a bear trap. Price must first close below an important level, and this induces breakout traders to go short. It's quite hard for me to explain what a key level means because that might be a little subjective. This is why I mentioned that this is more of an advanced strategy. In fact, if you are still struggling as a trader, you should look to trade with the trend setups. You know, patterns like ascending triangles, descending triangles, pullbacks to key important levels and such. I've previously uploaded a couple of videos that show you how to determine key levels, and I will leave a link to those videos at the top right and at the end screen of this video. If you need more help on that, definitely check those videos out next. But not to worry, I will run through a couple of examples in this video so that you will have a better understanding of catching a falling knife. Now once we see the flush, the last criteria we need is for price to confirm the flush. And that refers to having a confirmation candlestick pattern that closes back above the key level. It could be a bullish engulfing candlestick or a piercing candlestick. The key is that it must close above the key level that you identify. The flush has to be confirmed, and you get that confirmation only when price closes above the level. So quickly, let me do a recap of the 3 criteria because I want to break it down for you with a couple of case studies. Number 1, we need a strong bearish momentum. Number 2, we need a flush of the key level. And lastly, we need confirmation that the flush is valid by having a candlestick pattern that closes back above the key level. Right here, I have a chart, and this is a good example of the setup. I'd like you to pause this video and try to go through the 3 criteria and see if you can identify it. Now, did you manage to get it? Let's break it down together. We have the strong bearish momentum right here, a big extended range candle showing very strong bearish pressure. This is where most traders will chase the market and end up entering too late. Now right here is our key level. In this case, the key level is pretty obvious. One look and you should be able to tell that this is a swing point that is key. Price breaks this key level, which is what we want to see. Finally, we get price closing back above the key level, confirming that the flush is valid. Just have a look at what happens to price afterwards. It starts trending up, and this would have been a good trade. Now, of course, I cherry picked this example because I wanted to show you what the ideal setup looks like. But as you should already know, there's no such thing as 100% in trading. As long as you apply proper risk management and are consistent in executing this same setup, you should be able to turn a profit. Again, as I mentioned at the start of this video, this is quite advanced stuff, and your win rate for this strategy might not be that high. You are probably looking at a win rate of like 35 to 45%. But this low win rate is being compensated by big winning trades. Remember that this strategy aims to help you get in at the market bottom. So if you know it right and are disciplined in holding your winners, you are probably going to get 1:10 or even 1:15 risk to reward. Now let me run you through one more case study before ending off this video. Right here, we have the strong bearish momentum. See this big bearish bar right here? Pretty scary to be buying right into this bar, right? Anyway, the next thing we need is a flush of the key level. There's an important key level right here. Based on my experience, I know that this is a key level to pay attention to. I would say that this is a little subjective and you might not agree with me. But that's fine too, because you can always choose to skip the trade if you are not sure if that level is a key level or not. Price eventually breaks back above, confirming the flush of the key level. When we see this, then we can go ahead to take the trade. By the way, I forgot to talk about your entry and stop loss. It's actually really simple. Your entry will be when price closes back above the key level. And your stop loss goes below the recent low with a buffer. Nothing too complicated here. I won't touch on trade management and writing your profits here because that's an entire video on its own. I have previously uploaded multiple videos about maximizing your profits with exit indicators. Summing up this video, the proper way to catch a falling knife is to watch for a flush. Specifically, we need to see 3 things happen in order to catch the falling knife. We never want to blindly buy when the market is dropping heavily. We need to see bearish momentum, a flush of the key level, and finally a confirmation of the flush. That's it for this video. I hope you got a ton of value. As promised, I will leave a link to the video on how to identify key levels in the end screen right here. Do check this video out if that's something you need help with. Don't forget to subscribe, and I'll see you in the next video.